All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have Chris Krug. Chris is the president of Chatham Harbor Capital. Chris, how's it going?
Well, pretty well. Thanks for having me.
Great. Well, hey, let me start this podcast the way I do every podcast. First, we'll just give a quick disclaimer. Everyone should remember nothing on this podcast is investing advice. Go do your own diligence, consult a financial advisor, but nothing on here is investing advice. And then the second thing I'm going to do is start this podcast with a pitch for you, my guest. You and I have been talking off and on for a few years. I've always found you to be a very sharp investor with very interesting ideas. But actually, the pitch I think that works best is I told a mutual contact of ours who's going to remain undisclosed that you were coming on. And he said, "Oh, I cannot wait for that episode. Chris is one of my favorite people to swap ideas with. He is super sharp." So if that's not a good pitch for you, I don't know what is. But that pitch out the way, let's just jump right into it. The company we're talking about today is Performant. The ticker is PFMT. So I'll turn it over to you. Chris, what is Performant and why are you so interested in them?
Okay, so Performant is a very complicated story. So this is going to take a little bit, but I'm going to walk through everything. So it's a company that's going through sort of a gigantic change. So first, I should probably start off with the valuation. Market cap's about 200 million, 220 million. It's down a little bit today. Then there's about $35 million in net debt, $38 million in net debt. That's going to be coming down over the course of this year. So the EV is somewhere around 250 to 275 million. This year, they expect revenues of between 83 and 90 million just on the healthcare side. So you got something that's trading at a little bit over 2 times revenues, more or less, to EV to revenues. I think longer term, they're going to get about 40% EBITDA margins, and I'll explain later why. And I think in a couple of years, let's say 2 years, 2023, revenue should be between 160 and 200 million, depending on certain situations. So you have something that's trading at almost 1 times revenues in a couple of years. Longer term EBITDA margin should be above 40%. Or not above 40%, about 40%. There's evidence. Well, Cotiviti is one of the biggest competitors. They did 35% EBITDA margins. HMS, 28% EBITDA margins. This is more of a tech business than those are. Cotiviti secret sauce is there in the Philippines so that they have cheaper labor, but Performant's going to go to that as well. But okay, so what is Performant? So I hopefully I made it clear that this thing's extremely cheap. It's growing extremely quickly. Trading at 1 times revenues, it's going to grow at between 30 and 50%. Pretty much, I don't know how long, for a good amount of time. So what they do is it's a legacy student loans collection and IRS collection business. So think about how if you have a bunch of student loans and you miss payments and they have to collect $5,000 from you. Performant had a call center that they would basically collect that money and they get paid after a 9-month program. Okay, same thing with the IRS. They're not going after big people. They're going after people for $5,000, $2,000, something like that claims. Okay, that business was just sold. But over the past, let's call it, they went public in 2012. Parthenon took them public. They originally made their investment in 2004. So over the past, let's say, since 2014, they had $3.4 million in healthcare revenue. Now that's going to be 83 to 90. Okay. The student loans business was their biggest portion of the business. I forget what the numbers were in 2014, but it's something like 100, 200 million, something like that. But over time, the business has absolutely gotten decimated, as all your listeners can probably assume, with the Biden administration and COVID. With COVID, even the Trump administration cut off, you didn't have to pay your student loans anymore. So last year, revenue for the student loans portion of the business was down, I believe, 39%, and they were guiding towards down 45 to 55%. But remember, that's gone. Okay. They haven't announced what they sold it for, but it's going to be for something. Before previous conversations with management, they were talking about selling their contracts for about 2 to 4 times EBITDA. So I'm thinking that they could sell these things for $5 to $10 million, and that's sort of helping that deleveraging. Last year, $60 million in debt. Now $38 million in debt. I think by the end of the year, $25 million in debt. But the real juice is the healthcare business. So when I first found this thing, I didn't know what the healthcare business was. I just saw something grew 65% last year. It was trading at 1.5 times EBITDA on the equity stub. Very cheap situation. Those are the situations I like. I like situations where there's a good co and a bad co. And then the revenues and EBITDA are stabilizing. So that was this type of situation. But over time, I've been following the company for about a year now. And I've been doing calls every single week with management and IR. Sometimes they probably sick of me. Sometimes calling 3 or 4 times a week. But but this business is they audit insurance claims. So there's 2 different sort of verticals within the healthcare business. There's the audit portion of the business. So the audit portion of the business is more or less if you do knee surgery. And you get knee surgery, and the coders, because this is all done by the hospitals, and it's not all automated. I don't think it's ever going to be all automated. It's a lot of human touch to it. And from what I understand, they're lower paid workers for the most part, and there's a lot of turnover with the people that actually audit these claims, or not audit these claims, that code the insurance claims. But someone might mess up a knee surgery, and they might charge you something for brain surgery. So, and then it slips through the cracks that the insurance company pays for it first, and then Performant is a third-party vendor that comes in and audits these claims. And they basically have teams of nurses and doctors that go in and say, oh, this area, knee surgeries, for example, are likely that they've been coding it misproperly because the code for a right knee surgery is very similar to a code for brain surgery. Or like one type of knee surgery is very similar to another type of knee surgery, but the other type of knee surgery, you charge 5 times more. Even though, and so a lot of the hospitals may think, oh, we can get more money if we can try to go after that higher price knee surgery. So that's one portion. Another portion of the business.
Can I just add one thing? I mean, and correct me if I'm wrong, but this can be as simple as, the code for knee surgery is 0943, and the person putting it in puts 0944. And as you said, it's not always, because I just wanted to clarify, this is not always the hospitals as bad actors. This can be
not at all.
Fat finger. It can be all sorts of things that they're getting.
Right. There's a little bit of fraud, but most of it is just like people just miscoding, not on purpose. And the hospitals aren't directing them to do it on purpose. But it's just one knee surgery is very similar to another knee surgery, or one code's very similar to another code. It just happens. I mean, it's impossible. I mean, there's hundreds of thousands of different types of insurance claims. So, I mean, error just happens, and it always will happen. So that's the audit side of the business. And they work for the insurance companies to help them get money back. So they're a profit center for the insurance companies. The insurance companies don't pay them. They take a portion. They take between 15 and 25% of the money that they recover from. They work for commercial and CMS. On the other side of the business is eligibility. Eligibility is if you slip and fall inside of a Walmart. Let's say a 26-year-old male slips and falls inside of a Walmart. Who's responsible for paying the insurance claim? Is it his parents' insurance? Is it his company's insurance? Is it Walmart's insurance? Is one of their 50 other insurance? Which insurance is actually which insurance should be actually paying this claim? Another example would be if you get into a car accident and you break your leg. Let's stick with leg examples. Is it the car insurance that might have a $10,000 deductible or something like that, or umbrella coverage, and then it goes to the health insurance? Like which insurance is supposed to pay for this? So that's what Performant does. They're a third-party vendor to help the insurance companies and the CMS to do that. So we went through that. Okay, and they get paid a percentage of the money that they recover. So the way this is important. The way the industry works is, let's use United Healthcare for an example. So United in-house, the industry is gigantic. If you include all the claims, both refuted by United and the third-party vendors, it's gigantic. But Performant's going after, with 2 other players in the space, more or less, they're going after about $8 billion. The TAM is a little bit difficult to really pin down because a lot of it is blue sky on the commercial side. But it's about $8 billion that Performant's going after, and there's only really 3 independent players in the industry, and it's very hard to get into. But they basically get different passes. So every insurance company hires every single vendor. So there's there's Cotiviti, there's HMS, there's Discovery Healthcare, there's Optum and Change Healthcare for the most part, and then Performant. Optum and Change Healthcare are both owned by United, and so they're not, and they're very small portions of Optum and Change Healthcare's actual business. So those really aren't players in the commercial side anymore. Then you have Discovery, which is public. It's a subsidiary of about a $10 billion company. It's bought for $155 million. So it's hard to find too much data on them.
Which company owns them?
Metaplan, I think. MPLN is the ticker. It was a SPAC that just merged. So I know less.
I have some familiarity with Multiplan. Yep. Okay.
Yeah, Multiplan. And then Veritas owns Cotiviti, and they just bought HMS for 17 times EBITDA, and they're growing at 4% a year. So Cotiviti and HMS are the biggest competitors. So the way the industry works is, like, let's say for durable medical equipment, so DME, That's Performant actually has a national contract for that on the CMS side, but they also do that. That's usually how they get into the insurance companies. So United might be they have a DME vertical. They 100% do have a DME vertical. They don't might have a DME vertical. So United they might in-house get the easy claims, or so they have teams in their house. A lot of people misunderstand this business, and they ask, why don't the insurance companies do this itself? They do it themselves, and then you hire third-party vendors to try to get other claims. So at the beginning of every month, Performant gets all the data, all the claims that United paid out in the DME, and there are different passes. So the first pass is obviously the insurance company, the United Healthcare. They're going to do as much in-house as they possibly can because they don't have to pay out 15 to 25%. Then there's almost like a tech stack or pass system. So the person in the first place gets to look at the claims on day one. Then they decide which claims, and they get paid 15% of the money that they get. They get to look at all the claims. They get to decide which ones out of all these different claims are they able to actually refute, and they can get the money back. You can't refute every single claim because it makes the insurance companies look bad. So you have to have some degree of accuracy here. You can't just blanket every single claim into with the hospitals, because it decreases the relationship between the hospitals and insurance companies. And insurance companies are going to be like, why are you wasting my time with these things that are clearly right? Okay, so first company gets first pass. Let's say it's Performant. Performant gets first pass, and HMS gets to look at the rest of the claims. They get to audit the claims that Performant didn't look at. Then Cotiviti, which is actually owned by the HMS and Cotiviti, the same company, but they still work independently. Cotiviti gets a third pass. Discovery might get a fourth pass. Discovery gets 25%. Performant gets 15% because Discovery's in the last position. They're incentivizing them to do that. So yeah.
Do you? I just wanted to find the 15% just to make sure, because I can be very blunt, and we said 15%. I just want to make sure we hammer it home. The 15% is United paid a $10,000 claim, right? And then Performant's going to go and say, hey, you paid $10,000. You should have only paid $5,000. Or let's make it $6,000 so the math's a little different. You should have only paid $6,000. So we're going to save you $4,000. And of that $4,000, you're going to write us a check for 15%. So $600. So net, they're saving United $3,400 because they get the 15% claim, just so everybody can understand that.
That's perfect. Sorry, I didn't explain properly. So what is important here is that if you can deal with the insurance companies have no reason not to use you. They want to use every single vendor that is out there for the most part. I mean, it seems as though the commercial insurers only use that I know of. They only use the providers that have contracts with CMS, and you have to have a license with CMS to actually deal with their verticals. But the commercial insurance, this is newer for the commercial insurers. Performant is a newer company. They only had $3.4 million in revenue in 2014. Now they're growing. So a lot of the growth and a lot of the continued growth is just going to be signing on to different verticals within, let's say, United. So you grow 3 different ways. And we'll just keep United as an example. There are 45 different verticals within United conservatively. Some are prepay, some are postpay. Those aren't as important right now, so I'm not going to explain them. We can talk about this for 5 hours, but we'll just go over that. And then some of them are eligibility. Eligibility is 5, and then prepay and postpay are about 40. So Performant now has, on average, 5 verticals within all the large insurance companies. They have 4 of the 5 largest insurance companies. And then Blue Cross Blue Shield, they don't count. That's a mid-level insurance company. A large insurance company is over 10 million covered lives. So you can grow by getting a new customer. So they might get Humana. That's one way to grow. Okay. And when you get Humana, you might get 1 or 2 verticals. Usually Performant gets it by getting DME or home health, because that's what they have the national contract on the government side. And the reason why I'm talking about the commercial side over the government side, even though the commercial side has more, or the government side has way more revenues, is because the growth is going to come from the commercial side. So they have the national contract. It's called RAC Region 5 for the government. So they usually get the DME contract, and they go into the first pass. Usually you go into the 4th pass because going forward, because the legacy players have been there for a while. But Performant has gone into the first pass in DME because they have the national contract, and they're clearly the best because they have the national contract. So they're going to give them a look at all the claims at first. So you go in, you get a vertical, you get a new customer. Then you might grow by going into different verticals. So you might get home health, you might get hospice, you might get skilled nursing, you might get brain, you might get knee, you might get DMG, like all these different verticals, and then there's 40 of them. Okay, that's another way to grow. That's in, like I said, Performant has on average 5 out of 45 so far. So there's going to be a lot of growth going forward. But they have 4 of the 5 largest insurance companies.
And I'm guessing once you're in, right? So United Health approves me to do their DME. I'm guessing it's not hard to get approved for all the other verticals. I mean, obviously they're only at 545, so it takes time. But yeah, it's not going to be crazy hard because, as you said, these are non-exclusive contracts. So you've just really got to go to whoever the decision maker is and be like, hey, we're already on your systems. Let us be the fourth pass guy for you. And it costs you nothing. You only pay us when we save you money. So it really costs you nothing as long as we're not raising a huge headache or just filing all sorts of crazy claims.
Exactly. So it's hard initially when you have very little revenue to actually get the insurance companies to take a look at you. Because number one, it's hard to create these systems, right? You need the actual data. And insurance companies don't want to give you the data. So one of the advantages the third parties have over the insurance companies doing it themselves is that the third parties, they have data from CMS, Aetna, Humana, small insurance companies, large insurance companies in New Jersey, insurance companies in California. So if all this data together, and someone might be coding something wrong at Aetna, and then they can use that data to help someone at Humana catch that where they wouldn't have done it in-house. Okay. So you grow by new customer, new vertical within the customer, and then moving up in the tech stack, in the PaaS stack. So Performant actually for every single vertical they're in, so their largest customer, they have 12, the big insurance company, and then of the 5 large insurance companies, and then the average is 5. They're in the first or second pass, which is actually very rare because usually you go into the fourth pass. Okay, so they're in the first or second pass on every single one of their large insurance companies. So you're going to grow on the larger insurance companies over 10,000 covered lives, and you can get into 45 different verticals within each. And then there's the mid-level insurance companies that are between 500,000 covered lives and 4 million covered lives. They include Blue Cross Blue Shield in this. So there's 50 right there with 50 states, because those are states: Blue Cross Blue Shield, North Carolina, Alaska, whatever. Okay, so the large players. So I said there's Cotiviti, HMS, Discovery, there's Optum and Change. They don't play in the mid-size space. There's smaller competition there, but from what I've heard, they're not as good. One of Performant's keys to growing is they're entering the mid-level insurance level where there's less competition, but it's economical for them because I've heard that HMS hasn't changed their technology since 1995. I'm sure that's a little bit of an exaggeration. Same Cotiviti. These companies have grown by acquisitions, so they're less integrated. They're lumpy. It takes them a day to process claims, where it takes Performant 5 minutes to process claims. It's less efficient. Performance like the next level of technology, next generation of technology, because most of these other companies started in the mid 90s, the early or mid to in the 80s and 90s. We'll put it that way. I think HMS was started in 1995 or something like that. I can't remember exactly, but yeah. So Performant's going to go after the mid-level one. They're creating a SaaS solution for the lower insurance companies, and those are less than 500,000 covered lives. So that's that. So that I hope I explained well enough what the business model actually is and how the company can actually grow. Do you have any questions?
No, I think that was great on the business model. Were there other stuff you wanted to hit?
Yeah. A few more things. I just want to make sure that before we ask,
I think you explained it really well.
So that's how the revenues work. Also, I should talk about the integration process. So Performant, it takes them 6 to 9 months to actually integrate into the insurance company. So if they win a program now, it takes them 6 or 9 months before they can start running tests on the audits or on the insurance claims. Then it takes them 3 to 6 months to actually get paid off those. So Performant has very good revenue visibility, and they know what the revenue is going to be a year to a year and a half out. And then if you go take a step back, the way they win a program is they do tests for about a year beforehand. So they go into United and they say, let us do this vertical or something like that. So they basically beg them to let us compete. They get in. It takes a year. They see if they're winning. They know if they're going to actually win a program or not and get into the actual tech stack. Then they get into the tech stack, and then the 1.5 years actually begins. So you really have revenue visibility because they know how they're doing. So they basically make money for the insurance companies for free in the beginning. They know how they're doing probably 2 to 2.5 years ahead. So when the company comes out and says that we think that we're going to do X amount of revenue in the future, they know at least a year and a half in ahead, it's already booked. And then they know another 6 months, 9 months out, whether or not they're winning these programs. They're likely to win these programs, so they have visibility for another 6 to 9 months into the future. Okay, so that's, I think, a very important aspect, because you had some questions on revenue. Like I said, the TAM is something like $8 billion. You can say 4 to 8. It's unclear because the insurance companies aren't sure what they're paying improperly. So if from anecdotally from the company, from expert calls, from a lot of different sources, we've heard that Performant is by far the best, that they can come in and increase the amount of money the insurance company is getting back in the first round by 75%. So they're very, very good. And it's key here to understand that if HMS is not catching some claims, the claims that they're missing, Performant, if they're good, if they have a really good software, they can get those, and they have no competition on those because they are winning claims, and the claims are constantly changing. They're winning claims that the other insurance company or the other vendors aren't even noticing exist. So, and if you get the first pass, you can get a look at every single one of the claims first before anyone looks at it, and you can win a bunch of different claims. So that's sort of what they're doing. They're basically getting into the 4th position and then increasing the total amount of claims by 75%. That was a United quote, actually. And then they're moving up in the 1st position, and then they get the 75% plus the other claims that the first pass was taken before. So that's an important aspect to the business as well. So the CEO, who I think is absolutely fantastic, she basically had this dying business, and she reverted all the capital to start investing in this healthcare business and grew it from $3 to $90 million in revenue. Let's just use the high end, or midpoint is 25 times in 7 years. She thinks that they can get 10%. The company also has thrown out 30, 40%. They think over time of that entire market, because, and I've heard it from many people, the product's it works unbelievably well. You can, there are government documents I can send over later that talk about how the performance rate of Performant compared to the competitors. They're getting around 20% of the claims correctly, versus that's called their quality score. Their quality score is about 20% they're getting, where their competitors are getting like in the low teens, like 11 or 12. So they're almost 2 times better. The company says that somewhere between 8 and 10% is where the competitors are, and they get somewhere between like 18 and 25%. But I'm sure for different situations, this is data from 2018 that I found, but that's anecdotally from the company. So Performance clearly better than the competitors. On top of that, Cotiviti, which is one of the biggest competitors, is rumored to go public at 15 times revenue. Remember, this thing's trading at, and Cotiviti was apparently growing at 10%. So this thing is trading at 1 times revenues a couple of years out. People apparently think these are very good businesses, which I think they're absolutely great businesses. HMS got taken out for 17 times, growing at 4%. Cotiviti is talking about going public at 15 times revenues, which is, I don't even know how that's true. And they're only growing at 10%. Even if they were growing, they were going public at 7.5 times revenues, half that. Maybe that number's wrong. Still absolutely fantastic at 35% EBITDA margins. I think Performant's going to get better EBITDA margins than Cotiviti over time. They're talking about possibly going to the Philippines, and basically you would have your doctors and nurses that basically assist the software, have them based in the Philippines, and the labor's cheaper because that's a big portion of the cost as well. But a lot of this is AI. They have a very good engine, and it's purpose built for this. So the CEO thinks that they can get 10% market share, which would be $800 million in revenue and 40% EBITDA margins. Even you can use 30% EBITDA margins, and you what's that? $240 million in EBITDA. I think they're sandbagging it, and they could get 40%. I don't think they could get really above 50%. Maybe they can get 30%, something like that on an $8 billion company. Let's say 30% with 30% EBITDA margins, you get $2.4 billion in revenue. 30%, what's that? Close to $750 million in EBITDA for a $250 million market cap. It's pretty crazy when you think about it. It's actually like pretty silly that this company's trading at such a low multiple. And why they're growing, I said better tech. They use more AI than their competitors. built from scratch versus acquisition. The lowering the price isn't an issue because, I mean, HMS can lower the price all they want. If they don't get the claims that Performant is finding, then it doesn't matter. So when the price is an issue, like I said, there's really only two other players. There's Cotiviti and HMS, which are owned by Veritas. Cotiviti is about to go public, so it would be interesting to read that S1. We have Optum and Change Healthcare, which don't compete in the commercial side of the business. Discovery, which is a small portion of a bigger company, which you can probably make the assumption that they don't really care about it too much. But even if they did, still, you have essentially two other competitors in an $8 billion industry. Doesn't even matter. There's a big runway, and they have 1% of the market right now. So it's crazy. Very high barriers to entry. Like I said, on the CMS side, you need a license to work with CMS. And there's 5 RAC contracts. Performant has 1 and 5. 1 is the West Coast. 5 is the National DME Home Health Hospice. 2 is coming up this month in August. So that's big. That's double the size of 1. And Performant's frankly been kicking Cotiviti's ass. So maybe they win that. That could be a $25+ million contract in run rate revenue each year. 3's coming up next year. 4's coming up the year after that, and 5's coming up in 2024, I believe. So that's their risk. They just won RAC 1 again for 8.5 years. I'm not sure exactly how much revenue that was. I think it's somewhere between the $10 to $15 million range. So on the commercial side, the government side, that's the majority of the revenue right now, but that's not going to be a thing in the future. It's mostly going to be commercial, but you have these short-term catalysts that, God forbid, if they win REC 2 or 3, they might get $25 million for each of those. And then that's how you get to the $200 million in 2023 number versus the 160, or if things go tragically wrong, maybe they get around 150.
The government I'm not sure if the government would let someone have more than 2 RAC contracts.
Cotiviti has 2 and HMS has 1. So that's
3.
So
so I'm saying if Performant has 1 and 5, I don't think they could win 2 or 3 because I'm not sure the government would want one person auditing across the country.
My point is that HMS and Cotiviti have 3 together in their same company.
Oh, okay. So you think they could get up to 3? All right, then.
I think they could get. I'm not saying they're going to win all 3 of them, but they could win another one. And I'm just saying maybe. You know what I mean? That's not even built into my analysis at all. But I'm saying if they do, they might win another $25 million of revenue. But the real key here, and the reason why I'm bringing up at the end, and it's not important, is they're going to really grow on the commercial side of the business. So that's where the majority of the growth is coming from in the future. So I hope that was helpful. And I just wanted to walk through the entire.
That was super helpful.
Yeah.
Let me turn to question. And as I was researching this, and I'm really interested in the idea, but as you mentioned when you were going through this, you've done a ton of expert calls, and one of my big things is you've got to do the work, right? You've got to build the diligence. But the thing that kept jumping out to me as the big question, you mentioned it in your overview, right? There are really 3 kind of focus companies competing here. And you said, a quote was, it's very hard to get into. All the competitors for the most part are from the 90s. And I just keep in my head thinking, Performant really started getting serious in the healthcare business in 2012. And in 8 or 9 years, they've built up this company that is winning tons of market share, growing faster than competitors, performing better than competitors. And that's awesome. But at the same time, it made me wonder, if they could do this quickly, kind of starting from almost nothing, what's to stop Cotiviti from going and really upgrading their systems and turning it all around? Or a new competitor who, there are all these fintechs with great AI and what's to stop them? Because growing this quickly, great margins, pretty uncorrelated with the healthcare side. Everyone would love to be in this business. So why? I know you said that they've got a barrier and it's hard to get into, but when I look at how quickly they go to it, it does call that into question. So can you help me there?
Okay. So I think that's a very good question, but I think at these prices, I think that in the medium term, there's not much risk. I'm not arguing that in 10, 15 years, that there could be a tremendous amount of risk in another company coming in. But in the medium term, we know what revenue is going to be really in the next 2 years, right? We don't know. We know in a range, but we know they're growing extremely quickly. In Q4, their run rate revenues increased by, in terms of this revenue is going to show up in 2022. They increased those revenues by $9 million or $8 million or something like that. In Q1, it was something similar, I believe. So they're growing. They added in 6 months $20 million in run rate revenue. You have the revenues that are going to show up later this year, they should be at 25 run rate or something like that. So you're going to be at $100 million run rate by the end of this year. First quarter was about 17. Then there was a charge off, and we can go into that later. It's not really important, but we can go into that later. But my whole thesis is around I'm not arguing that this business is going to be around for 50 years. I'm saying at current prices and the current growth rate and the current momentum that they have, and from doing calls and talking to people, it doesn't sound like their competitors are even remotely aware that they're aware, but they don't view Performant as a huge risk, and they're not doing anything to compete with them. I think that HMS probably could change their software. Whether or not they can do it well with 6 different types of systems doing it, maybe they have to build it from scratch. I don't really think 9 years. I think 9 years is kind of a long time, actually. So I mean, if in the medium term, I just think there's very little risk to competition. The longer term, yeah, it could possibly happen. I don't think this is sexy enough for VC. I think it's hard to actually, it's not impossible, the barriers to entry, but I think it's hard to actually get these licenses. It's hard to convince the insurance companies. It took Performant forever to actually start winning these contracts. I mean, Hops has been around since the 90s, and they had 1 or 2 on-off contracts through the years. And then they started really growing in 2014. So, I mean, I'm sorry that's not the best answer to your question, but I think if we get over $150 million of revenue in 2023, company's $250 million market cap, the debt's going to be completely paid off. There are a few warrants, or $5 million. So there's 5 million warrants. There's 55 million shares outstanding. So it's really 60, let's call it. But they have some cash. If you include the cash at the end of this year, they're going to be, I don't know, they'd be closer to $20 million in net debt after the sale of the other business. But I'm saying in 2 years, I mean, you have something that one of the competitors potentially could go public at 15 times revenue. This thing's trading at basically 1 times revenue in 2 years. I don't really see that much risk there, to tell you the truth. I think it's kind of silly. I'm not saying that forever there's never going to be competition, but I think it's kind of silly in the short term, to tell you the truth, the valuation.
So let's talk about the growth a little bit real quick. So I just want to pull 2 different threads together, right? You mentioned exiting the year run rate 100 million in revenue in the healthcare division, which I guess is the only division at this point.
Something like
that. Then, but you also mentioned, and I love this point earlier, you said, hey, when they get a new client, like they've got great visibility because it takes a year to get someone to sign up as a new client. And then once you get them, it takes another 6 to 9 months to kind of get integrated, and maybe a couple months after that to really get rolling in the system. So, it's a 2-year process. They could land every insurance company in America today, and it wouldn't affect their numbers probably till the end of 2022 at this point, right? So I just wanted 100 million run rate revenue, but they landed 10 new programs in Q4 20. That's probably not really hitting the numbers at that point. 5 new programs in Q1 21. So if I was talking about, if you just rolled those programs in and talked about what the run rate in mid 2022 looked like, how different would that be versus the 100 million?
And that's sort of what I'm saying. So it looks like that's going to be around like 115 to 120 million bucks.
Okay.
That's just and that's assuming that they don't win any more programs. But as we discussed before, it's once you get in, and I wanted to make a point that they have an average of 5 programs within these insurance companies, and they have 45 total conservatively verticals. That's a low hanging fruit, and the insurance companies want to use them because with United they increased their revenues by 75%.
Yep.
In the first round. So there is a barrier to get into the actual insurance company, and then also as they get into the mid-level insurance companies, they're expecting 3 to 5 program wins. Granted, these are small programs, but 3 to 5 program wins, and this is basically a completely wide open strategy there's very little competition for the mid-level insurance companies, and for the small insurance companies, no one can even deal with them because they're so small, and it doesn't make economic sense to audit 15 claims. So they want to create, or they have created, from what I understand, a SaaS business for the lower insurance companies. So okay. that's basically how you're getting to those revenues.
Perfect. So 100 million run rate revenue by end of this year, maybe sometime next year they're on 150 million run rate pace. Let's just take that 150 million. How much of that is from the Medicare program versus how much of that will be from the commercial programs?
Most of it's going to come from the commercial. I mean,
most of it's coming from.
Most of it. I don't think the government revenues are going to grow that much, unless they win a RAC 2 or RAC 3 contract. That's just free money. I mean, if they win one of those, that just boosts the thing, and you get $5 extra on the stock price.
Of the 100 million right now, how much of that is government?
Government, what was it? Here, let me pull up the financials. I think government was like 40 last year, and it was 20 commercial, and then commercial is going to be the majority of the growth this year. So you're going to be closer to it's going to be the majority is going to be commercial. It's going to be maybe 60-40 commercial, and then it's going to keep growing on the commercial side.
I'm just teasing out because, the Medicare, probably a little growth, but that's pretty steady. And it's just crazy, right? As you said, hey, they're going from 100 to 150 million run rate, which is huge. But if you actually broke that down into Medicare and commercial, the commercial is growing exponentially faster because the Medicare is pretty steady. That's pretty crazy.
Exactly. So commercial is just growing at huge clips, like absolutely huge clips. But the CMS, obviously, like there are only so many contracts. I mean, they're just going to grow at GDP plus or whatever. But that's not the right.
So you bridged me to run rate 100 million in revenue this year, run rate hopefully probably 150 million in revenue by sometime next year. EV 275 million, we'll call it. So trading at kind of under 2 times next year's run rate revenue. So I guess my question is, you mentioned several times 40% EBITDA margins. And, if you put that on a 2 times EV to revenue, it's 8 times EV to EBITDA. This is going to be a great cash flow business because it's pretty much all data, very capital light. So my next pushback would be 40% EBITDA margins. Where is that assumption coming from?
Okay. So the company's saying mid 20s to low 30s EBITDA margins for the most part, or around 30% EBITDA margins. But if you ask them the question, why can't you do better than they're way more into, it's a way more software, sort of AI intensive business than HMS and Cotiviti. And I suggest your listeners to call the company and ask, why can't you do better than Cotiviti? And they'll laugh. And Cotiviti has 35% EBITDA margins, and there's way more tech involved. They're going to start moving their stuff to the Philippines, but it should be. Maybe they don't get 40, but I think it's possible that they can actually get 40% EBITDA margins. Even if you say 30, they could do it. There's evidence. HMS, they did 28% EBITDA margins. Cotiviti did 35% EBITDA margins. These are the same business models, same business. But the only difference is Performant is more tech enabled than these other companies. So that's where it's coming from.
Yeah,
it's a little bit difficult to understand.
It all makes so much sense to me. It's still, there's something in my mind that's saying like this company, what was HMS revenue before they got bought out?
I think 400, something like that. Maybe HMS got taken out for $105 million in EBITDA or something like that, if I remember correctly.
It strikes me as so strange. Like, I know larger competitors can be slow to respond, and this is why sometimes you grab a smaller company by the tail and they grow and they just destroy it. But it just strikes me as strange. HMS, a company with 400 million in revenue, 100 million in EBITDA. I know it's going to take a while, 6 different systems to integrate and stuff. It just strikes me as strange that they couldn't make a reinvestment when Performant is clearly taking so much share. They couldn't make a reinvestment and go hire a bunch of data engineers and do something to kind of try to keep their share at least,
Yeah. So this is my response to that. So Performant grew at 65% last year to get to 67 million. So if you look at 2019 revenues, they were like in the 30s. And that is, people barely even know they even exist. So I think that HMS is getting to the point where they're realizing that Performant is actually a player. And I'm not disagreeing with you. HMS and Cotiviti probably could make a better type of product, but they might have to gut it, to tell you the truth. They might have to build something from scratch, and it could take a while. But my whole thesis is not that Performant's going to be, they could get a 10% market share, and there's really only 3 players, right? I mean, they could get a 10% market share and be the loser in the game, and they could still be worth a tremendous 50 times what it's worth right now. But yeah, I don't disagree with you. I mean, HMS could. I mean, that is a risk, but I don't think it's a midterm risk. I think it's a longer term risk, and they have to actually care that Performant exists. It's the innovator's dilemma as well, right? Why not just milk what you have? And they probably don't think that the head of product development there probably doesn't think that Performant's any good. And that's why he does what he does. You know what I mean?
Yeah, no, I'm with you. It strikes me as crazy. A publicly traded company in an industry with, kind of 3 pure plays could report revenue growth this good and take this much share. And then HMS can just kind of sit on their hands and, it's the dog sitting in a house while fire burns around him saying this is fine type thing. It's like, it's so clear they're taking so much share. it just seems crazy to me that they're not going to respond.
Yeah, I mean, they probably will respond. They'll do something. But I mean, at this point, Performance already have so much, they have so much momentum that, I mean, the stock's so cheap. I mean, that's a question when the stock's $30. Right now it's at $4.50 or whatever it is. I'm not watching it right now. When the stock's at $30, that's a very relevant, like, important question to answer. Like, why won't HMS crush them? But right now, I just think it's so cheap. It's like, it's the most silly thing I've ever seen.
Let me ask you my next question. This transitions, it wasn't going to be my next question, but it transitions perfectly to one of the key risks that, I think I had a couple other people threw up. You said stock's at $4. You're going to ask that question when it's $20, $30 per share or something, right? You've laid out this great growth track, right? This great growth story, cheap valuation once you standardize the number, taking huge shares. So the next question is clearly their majority shareholder it's Parthenon, very respected private equity firm with great returns historically. They've been blowing out of their shares, right? I posted on Twitter, people can go find it. They've sold shares constantly every day this month, starting in the threes. The stock, as you said, 450. I mean, they're blowing out of
238 was the first sale.
Yeah, I'm only looking at the July one so far, but I'm now looking at the Junes, and you're 100% right. 238, and they've blown out of millions of dollars of this thing. I'm doing the math in my head, right? I think they've sold over 5% of the company within the past month. So if this growth story is this good, Parthenon's been in here, understandably, they've been in here a long time, but obviously they've got visibility into the growth story. They've got board seats. Why are they blowing out right now when the growth story is this good, the company's this cheap?
I've tried to talk to them. They won't talk to me, but this is what I've heard. I've heard that they made the investment in 2004, and you worked in private equity, and I know a bunch of guys in private equity. I don't think many people want to hold an investment for 17 years. The company didn't trade for the last 5 years. I mean, what was the ADV, like $50,000 a day or something like that? It literally didn't trade. So, I mean, I think it got to a point that people started really realizing what this was, and they got a free $50 million or more than that. And I think they just are going to sell it. I mean,
so you're thinking this was a write-off to them, right? They had written this thing off.
Yeah, I think so. Well, healthcare wasn't even a big portion of the business until a couple of years ago. I mean, when you look at the numbers, the student loans portion of the business was like 90% of the revenues in like 2018. And healthcare, they might have known about healthcare, but they invested in this business when it was a student loans collector. It's not. So, I mean, I can't give you a good answer. If I was in their situation, I wouldn't be selling this thing. But to each his own. I mean, they probably have a new fund that they're raising money for, and they just $50 million.
Yeah, and the stock as recently as last September was a 60-cent stock. Today it's a 440. So I'm sure you are right? They had ridden this darn thing off, and then the stock 5x on them. They said, "Oh, we can close this out, get some money." It does make sense, but at the same time, like they've just been in it so long, and they've been in it for a long time. I'm looking at the chart. In 2014, this was a $10 stock, and they held their shares, and I always get a little hesitant when there's a big private equity player and everything seems to be going right, and they sell kind of right before the payoff seems to come. But yeah, I told you the last time we talked, this has been wrong for me before, right? BXC, which is a lumber distributor, Cerberus was the owner. They blew out of their whole stake maybe 5 years ago at $7 per share. And 2 years later, BXC was a $30 stock. So the private equity guys definitely get it wrong, much like everyone can get it wrong. But that's just one thing I know that jumps out to me.
Yeah, and on top of that, I mean, do you really think, there's a real possibility the person that made the investment in 2004 is probably not even with the company anymore. Now, and passed down to, at one point, it was less than a $10 million position. I mean, like, these guys are good. I mean, like, do you think anyone really cares about $10 million? I mean, it could be a junior analyst that could be running the show. Who knows?
The person who made this investment, not only is he not there, but his associate is no longer there. His analyst is no longer there. His analyst is no longer there at that point.
Yeah. So
$100 million in revenue this year, 30 million.
No.
Run rate by the end of this year.
Run rate. Yeah.
They're not had 40% EBITDA margins yet, but they're going to get there. 150 million. This thing's going to be throwing off a lot of cash. They've got about 40 million in net debt right now. A little bit under it, just throwing the numbers out there. By the end of next year or 2 years from now, I think all the net debt will pretty much be gone. These businesses, as you said, a lot of them are private equity owned. They can handle a lot of debt because they've got great visibility. They've got great margins. They don't have a lot of CapEx. So in a year or two, what they're going to do with their cash flow and their capital allocation is going to become a high quality problem, but it's going to become a problem and it's going to become a question. What do you think the company's capital allocation strategy is going to be as kind of the cash flow really starts pouring in? Because that's going to make a big difference. Obviously, if they can get to 100 million in EBITDA and it's 200 million stock right now, it'll be fine either way, but it will make a big difference on the margins.
Yeah. So just to take a step back, there was a shelf that was filed last night, and it looks like the stock is down today because of the shelf. I'm talking to the company, and I haven't heard anyone get a different response from them.
On the shelf? I will just let you know, 2 people emailed me, was like, of course, the company heard there was a podcast coming out and they're like, we got to get that shelf offering right now.
Exactly. So to be clear, the company had a shelf in 2014, 2017, 2019, 2021. The share count has increased from $50 million to $55 million. It's like negligible in 6 years. I mean, it's probably just stock options. So the company, to me, seems like they're allergic to issuing shares. So I mean, from our conversations, they're going to buy back shares with the cash. They think their company is so cheap, it's like ridiculous, and they understand what's going on. I wish Parthenon would stop selling and they can make some money for themselves, but I guess to each his own. They're better at making money in other ways. But it sounds like the company's going to buy back shares, and when this cash flow came through, that was a big question I had a couple months ago. Like, what are you going to do with this? And they were like, honestly, there's not that much competition. We could go into different verticals. Like, so Optum went into a bunch of different verticals, Change could, but they like what they're doing. And I think they're just going to keep buying back shares, or they're not going to keep buying back shares. They're going to start buying back shares.
Yeah. I wonder if there's a deal to be done, do a block purchase of some of Parthenon's shares, take that overhang out, deploy some cash early, keep the leverage at a level that's kind of consistent where peers are at.
Yeah. Well, the company, people have been buying the shares. I think there's been 4 or 5 different buyers of Parthenon shares. They're down to 7.5 million. They were at 14 million a couple months ago.
Yep.
I mean, next thing we know, those are going to be gone. I mean, Craig Hallam and Collier's just picked up research coverage. Apparently, people are extremely interested. People are seeing what I'm seeing, I think. So I think that's going to be gone. And I don't even know. I mean, this could be a crazy situation when Parthenon's done selling.
One other thing on PFMT, there's always going to be, we mentioned earlier, this is not all fraud. A lot of it is fat finger, you put in the wrong billing code, a lot of different stuff. But right. I do wonder, a lot of this comes down to America's medical system is flat out wasteful, very fragmented. And I do wonder with this, like, how much of this is, it's not a bad bet to take because betting on health reform has proven to be pretty difficult, but how much of this is kind of, hey, you are short any type of healthcare reform or major overhaul or anything?
No, not at all, actually. If there was single payer healthcare, here's a stat from one of their decks. The government is like 88% efficient in finding claims. Okay. So there's 12% error rate. Commercials like 6% error rate. So they're 94% of it, 94% effective. So actually the government would, and they probably do less in-house at the government as well. So if they went to single payer, the market might triple because they would outsource more and more of this because that's the third-party vendors' jobs, where the commercial, they're in the business of saving themselves money. You know what I mean? Where the healthcare, the United States healthcare is very, like you said, very inefficient. So, I mean, it would be to an extent a very good thing if we went to single payer in terms of performance business.
That's great.
Yeah, you get what I'm saying? So.
Oh yeah, no, I get it. And it might even be better because they've got the 2 RAC contracts. Obviously, it might not be Medicare for all or whatever, but right. They've got 2 RAC contracts, so they've clearly got government experience. They'd be a major beneficiary. That's great because in my head, I thought that was kind of the kill shot for them, right? Like you get some. Yeah. Give me a postmortem on this. Obviously, you're hugely bullish. I think people can tell when you said, "I'll worry about that problem when this is $30 stock and this is $4 stock right now." So you're maybe not dreaming. You're rationally thinking big. But give me a postmortem. What destroys this company? What kills this investment for you?
I think that you brought up some good points. I think HMS or Cotiviti creating something better. I just don't know how possible that is. But that could be. And I'm not arguing that this company is going to be here in 50 years. So over the medium term, a kill shot, well, there could be volatility, right? Parthenon is selling on the open market. They could decide they want to just dump 7 million shares, and you could get absolutely obliterated in the short term. So by them, that's a short-term risk, right? But obviously,
that's stock price. That's more stock price movement and volatility than the business actually missing what you're saying.
Yeah, the company talks about execution being the biggest risk, and them actually executing the stuff. But from people that I've talked to, I just don't really see how that's going to be a problem at $4 a share. At $20 a share, and they stop executing as well. It's not like they're going to get kicked off once they're in one of these verticals. It's not like they get kicked off. They just get dropped down to number 4 because they can still find some claims for the government. They have Iraq Region 5 coming up. That's in 3 years or something like that. That could be a problem. The debt, I just don't think the debt's gonna be a problem. I think this is pretty much as perfect of a situation as you could possibly. I mean, I don't know.
Have there been any rack vendors who've gotten hit with big fines or anything?
So there was, Performant didn't get hit with a big, Performant didn't get a fine, but they have this MSP contract where there was a $3 million write-off. That was an issue, but it's not really that big of an issue. So basically what they did was they got paid for a claim that shouldn't have gotten paid, and they had to refund the money. There's short-term things like that stuff just sort of happens. I'm not sure what exactly it was for. They wouldn't tell me. But $3 million, but I mean, on $90 billion, really, who cares? It's what, 3% or 4% or something like that. That could be a short-term issue. If that starts popping up a lot, then maybe we have a little bit, maybe this technology isn't as good. I keep trying to get in touch with as many people as touch this technology as possible. And everyone just says it's really good. I mean, there are always issues, right? I mean, this could be a gigantic fraud. I mean, but I doubt it. I mean, I've talked to enough people that I think it's highly unlikely. I mean, that could be an issue, right? But the debt could become an issue, maybe. But I don't think so. I mean, I mean, they're going to have $20 million in net debt by the end of this year, and the next year they should be doing at least. It's going to be trading at 1x EBITDA, or not EBITDA. Sorry, net debt to EBITDA.
No, I was just wondering on the rack contracts, because I'm not aware of anyone who's gotten fined for a rack contract. But the classic thing, and this is more on the DME side when you're selling equipment to Medicare, right? Then obviously this is different. But the classic thing is, hey, this company looks super cheap. It's trading at 5x EBITDA. It's growing super quickly. 80% of the revenue is to CMS. And then they come out and they say, hey, this company was defrauding CMS, or hey, CMS has reviewed your pricing structure. You were at 20% EBITDA margins. CMS doesn't like that. You're going down to 10% because they're giving you a 10% price reduction, retroactive 6 months. Right. Take it or leave it. We're 80% of your revenue. So those are just kind of I was wondering if there was something there, but it
I don't know.
Seem like it. Yeah.
It doesn't seem like it. I don't know. I don't think so. I don't think there's a huge risk. They could. Yeah. So
we are right up again at the 1 hour mark. As you know, I've got a hard stop in about 10 minutes. So I want to make sure, I think we've talked about a lot. I think you did a great job of covering the overview of the company, but are there any points on the bull side, the bear side, anything that you wish we had addressed that you want to make sure our listeners take away with them?
I just want to make sure that people understand how fantastic a business this is, that there's no political risk on terms of in the CMS side, because they're saving the government money. I can't remember how much they saved, but billions of dollars of money. I mean, there's no reason why they're going to get attacked for that. The fees are lower for the government than the commercial side. I believe they're lower than 15%. So I just don't really think that there's that much risk there. These contracts on the government side are very long, 8.5 years. They have one coming due, maybe they win another one. But I mean, that's pretty stable revenue on the commercial side. This is, I think, just about as fantastic of a business as I've seen in terms of there's not really that much competition. The competition is really not that good, and they're just eating their lunch. They're immediately getting into the 1 or 2 pass, and their competitors who they're destroying are going to go public at 15 times the revenues, growing at 10%, where this is going to grow a lot faster. I just think it's silly to tell you the truth. It's like kind of crazy.
I don't know if you short or not, but would you? Nothing's investment advice, but if one of these competitors whose lunch they're eating comes public at 15 times revenue, would you be tempted to put a short on?
Okay, so a SPAC deal just happened. with this company called, yeah.
You and I, yeah.
I'm not short in this, just because it's just too crazy, and I just think something bad could happen. But there's this company called MSP Recovery that looks like it doesn't look like, it's a law firm, and they basically sue insurance companies on behalf of the government, and they make money. That's on the MSP side of the business. I brought it up a little bit earlier. Very, very small portion, but it's a fast growing portion in performance. But in the long run, MSP it doesn't matter. But this company went public at what? They bought 0.5% of the company at a $33 billion valuation with zero revenue. And then if you don't redeem your shares, you get a minimum of 35 warrants.
It's, so anyone who's followed especially the blog, we don't talk a lot about SPACs on here. My blog, my Twitter, whatever, knows I follow SPACs very closely. I'm very interested. I think they create really interesting trading opportunities. You and I talked about this deal. I've posted some stuff on it.
Never seen anything like this.
There's a lot of shenanigans going on at that deal, and I'm going to leave it there because I don't want to get in any trouble. But
I don't want to get in trouble either.
Yeah, people can go find the tweet. It is one of the craziest SPAC deals I've ever seen, and I'm looking at the tweet I put up right now. It's a $230 million SPAC. There's no pipe into it. Most SPACs like to come public with a pipe because it helps cover a lot of the fees with the SPAC, and it shows people that serious institutional investors are buying into whatever they're pitching, or maybe not even serious, at least some institutional investors are buying in. No pipe in this deal, $230 million in trust, $160 million of that cash goes to the balance sheet, $70 million of that cash goes to transaction costs. It is a wild deal for a company with zero revenue right now. Wild, absolutely wild.
And on that note, we should have Performant trade at that valuation.
There you go. I said you were dreaming big earlier, but now you're dreaming really big.
That's the proper valuation, in my opinion.
Chris, where can be, if people want to, I know you have been driving the PFMT bandwagon. There's actually some other really good research out there, but I think you're clearly kind of the thought leader on this. Where can people reach you if they want to swap thoughts on PFMT or anything else?
They can email me at Krug at chathamharborcapital.com, on Twitter at chcap2016, and that's good. So.
Perfect. I'll put his Twitter link in the show notes so everybody can reach out to him on Twitter. I don't like to put emails in the show notes too much, but Chris, this has been fantastic. Super interesting idea. I'm still wrapping my head around it. I know you're driving home. I just want to gain more confidence on this. How are they, in 7 years, how did they grow to beat people? Because the rest of the story, I've got the revenue visibility is great. The rest of the story is so good, but super interesting idea. I really appreciate you coming on and sharing this idea, and looking forward to having you on for the next one.
All right. Thanks. Appreciate it. Thanks for having me.